Welcome learners. I am Dr. Vikas Agarwal from Amrapali University, Haldwani. Today we are here to discuss your new topic, that is asset allocation. How do we do asset allocation? This is the major question of the process of asset allocation, that how do we do asset allocation? Identify investor profile. This is the first step in asset allocation to understand the investor's financial goal, age, income, expenses, and ability to risk tolerance. That is also called risk appetite. Define investment objectives. Determine what the investor wants to achieve: capital growth, income, or capital preservation. Select suitable asset class. From the list of assets, choose the suitable asset class for investor. Choose from equity, choose from bonds, real estate, and various alternatives. Assign weights. Allocate a specific percentage to each asset class based on time horizon and return expectation. Implement investment. Choose suitable securities or financial products under each asset class. And last is review and rebalance. Regularly monitor the portfolio and adjust the allocation to maintain the original or revised investment plan. This is called portfolio revision. What are the major assets allocation strategy? There are three types of assets allocation strategy. First is strategic allocation. The primary goal of strategic asset allocation is to create an asset mix that seeks to provide the optimal balance between expected risk and return for a long-term investment horizon. This is called strategic allocation. Second is tactical allocation. Tactical allocation is a strategy in which an investor takes a more active approach that tries to position a portfolio into those asset sector or individual stocks that show the most potential for perceived gains. This strategy also based on market opportunities. Third is dynamic allocation. In dynamic allocation, that portfolios are built by allocating to an asset mix that seeks to provide the optimal balance between expected risk and return for a long-term investment horizon. The asset allocation, the types, the category, the various parameters, on the basis of parameters, on the basis of risk, there are various categories for an individual to invest their amount, to invest their saving. On the basis of the level of risk, the asset divided into various categories. It may be equity, that is high risk, but return is also expecting to high. That is stock, shares, or equity-based mutual fund. Some securities are providing fixed income. It is bonds, debenture, fixed deposit, government securities. In that type of security, the risk is moderate. Money market category. This treasury bills, commercial paper, certificate of deposit. In this type of security, the risk level is very low. Some investors want to invest in real assets, that is real estate, gold, silver, and any metal. Some investors are going to invest in arts, antiques, commodities, hedge funds, etc. Some investors are very conservative. They don't want to take risk. They are investing in a PPF, NSC, insurance for the purpose of tax saving or maybe safe return on their investment. The asset allocation basically have three major practices. Number one is asset allocation. It refers to the broad decisions of how much to invest in each asset class. Diversification. Diversification involves spreading investment within asset class across industries in equities to reduce exposure to a single risk source. The portfolio should be in the manner of diversified. Your portfolio is to be diversified. Third is portfolio revision. The process of restoring, rebalancing, revision the original asset allocation when market movements cause a shift in proportions. It is the periodic adjustment of the portfolio to maintain the original or desired asset mix, ensuring alignment with the investor's risk return profile over time. So, these three practices help to maintain portfolio discipline and prevent emotional or impulsive investment decisions. So, from the above discussion, we have to conclude thus asset allocation stands a foundational concept in both investment and financial planning. It shapes the structure of a portfolio in a way that not only aims for returns but also ensures protection against risk and uncertainties. Whether the market is rising or falling, a well allocated portfolio provides consistency, adaptability, and direction towards achieving life goals. Asset allocation is different for each person depending on their goals, risk taking ability, risk appetite, etc. There is no fixed rule or benchmark or standard. So it is important to plan according to the need of investors. Learning outcome of these lectures are the learners will be able to define asset allocation and articulate its core objective such as maximizing returns, managing risk, preserving capital and aligning with financial goals. The students will understand how asset allocation serves as the foundation of financial planning and supports long-term wealth creation, capital preservation and life goal achievement. The learners will also able to categorize and evaluate asset types like equities, fixed income, real estate, shares, debenture, and alternatives according to their risk levels, liquidity, and expected return. The learners will be able to identify and compare different allocation strategies based on investment objectives, market expectations, and risk tolerance. The learners will learn to analyze how individual risk profiles and investment time frames influence asset mix and portfolio design. Learners will be able to explain and implement diversification techniques and periodic rebalancing or revision to maintain portfolio stability and discipline. The learner also will be able to compare different approaches to asset allocation and determine their suitability for various investors' profiles. Last, students will recognize the significance of governance in maintaining consistency and objectivity in asset allocation decisions over time. Thank you very much.